Hi, everyone, and welcome to the Cliffwater Direct Lending Index quarterly webinar for 3Q25. My name is Fran Byers, Head of Capital Markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO at Cliffwater and the creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor founded in 2004. We are active across the alternatives investment spectrum. Today's format will include Steve recapping direct lending return performance for the third quarter, and I will follow with a brief recap on the deal environment within the direct lending market and provide some visibility for what is to come heading into the new year. And with that, Steve, please start us off.
Thanks, Fran, and thanks everybody for joining us. I'm going to be focused on our flagship index, the Cliffwater Direct Lending Index, or CDLI, as it's more commonly referred to. We also publish a number of other indices, which you can check out at our index website, but I won't spend any time on these others. Turn to the next page. Basically, CDLI performance for the year has been very consistent and very boring. The table at the top of this page first shows interest income in the top row at a little over 10% for the year, for the quarter, for the trailing 5, 10, and from inception period. So as I've said for a long period of time, from an income point of view, it's close to or above a double-digit yield. For the trailing year, it was 10.67%. There are generally two detractors from interest income. The most important and the more permanent one is net realized gains or losses. 99% of the time, it's a loss, reflecting losses from defaults. But for the trailing year, that was minus 61 basis points. Note that that is well below the long-term average of minus 1%. So losses have ticked up a little bit, but have been really pretty consistent over the last year and well below the long-term average. In fact, for the most recent quarter, realized losses were approximately 10 basis points. Unrealized losses, these are changes in marks. For the last year, it was down 20 basis points and about zero over the last for the third quarter. All in, the interest income of 10.67% minus those realized and unrealized losses for the last year, 9.80%. I show at the bottom a history of quarterly CDLI total return, again, all three components together, for the last 21 years. Compound return being 9.55%. But you'll notice a pretty boring chart showing small positive returns averaging over 2% for most of this period, interrupted pretty infrequently by a quarter of losses. Most of the time, those losses are insignificant, as in 2011 or 2015, the Euro crisis and oil crisis, respectively. Two more serious were the financial crisis in 2008 and COVID in 2020. Both those losses were mid single digit. So importantly, over recent periods, the quarterly periods, as you can tell, really not much to talk about, pretty consistent and attractive returns. The business press, particularly Bloomberg, has been really on private credit for reasons I can't figure out. But basically, the underlying data is very supportive of private credit, both from an absolute return and a relative return. importantly, focusing on interest income on those bars, showing a quarterly interest income, annualized, ending at 10.67%, the most recent third quarter. Basically, it's trying to capture as much of that yield as possible, avoiding realized losses. The red line shows realized losses over this period of 21-year period of time, averaging 1%. But over the most recent period, if you look at the right-hand side of the chart, that red line, it kind of has settled in at about 61 basis points. So basically, we're trying to capture the difference between the yield over 10 and loss rates under 1%. As of the end of the third quarter, that yield net of realized losses was 10.06%, so double digit. Long-term average difference of 9.90%. So again, the attractiveness of private debt is the high interest income with minimal offsets from realized losses. That investment hypothesis has not changed since we first started talking about private debt 15 years ago. The next thing I'd like to talk about is unrealized losses. Unrealized losses basically average zero over a long period of time. Basically, private credit, you either have a realized loss or it matures. So basically, unrealized losses are a predictor of future realized losses. So on this chart, I show quarterly, and if you look at the green bars, I show quarterly unrealized losses for a trailing 4-quarter period, and then overlaid by realized losses for a trailing 4-quarter period. And if you look, unrealized losses are basically a predictor or a harbinger of future realized losses. Loans get marked down by independent valuation firms on their assessment of future defaults. So, for example, if you look at the financial crisis back in 2008, unrealized losses at their peak were minus 16%. Okay, in advance or anticipating subsequent realized losses, which, by the way, peaked at 9.30%. This is the other point. Unrealized losses are a future predictor, but they generally overshoot. They're much more conservative than subsequent realized losses. So the 16 forecast was much greater than the 9 realized. Fast forward to the oil crisis in 2015, the valuations had suggested unrealized losses at their peak of 475, again, anticipating future realized losses, which also picked up, but were less than half of what were predicted, realized losses at 1.86%. COVID, much stronger signal, unrealized losses at 7.44%, but they actually realized losses were only 3.30%. And then 2022, the spike up in interest rates, again, marks fell, unrealized losses 2.62%, realized losses peaked at only 91 basis points. So again, unrealized losses don't hang around. They're offset to produce realized losses, but they are a predictor, pretty good predictor, but they overestimate realized losses really in every downturn. So there is a reason I'm pointing this out, which hopefully you'll see in just a second. So if I'm thinking about CDLI in 2026, basically we put it together a forecast. So what do we expect unlevered gross of fee performance for the CDLI to be in 2026? The answer is 8.85%. How do we get that? If we look at the 2026 forecast, that middle column, we start with 30-day SOFR. So we look at the forward curve for next year, SOFR forward curve. This is the reference rate for loan coupons, 2.5%. We add the credit, what we expect credit spreads to be for CDLI, including OID, that's 6%. Okay. Get total interest income combination of the two of 9.50%. Looking at the far right-hand column, let's look at the last 4 quarters. So we're predicting a decline in SOFR, not surprising to anyone. The last 4 quarters, ending September, 4.28%. We are expecting a lower level of credit spread, 6% versus 6.39% over the last 4 quarters. And it's primarily the decline has already happened in the marketplace. The prior 4 quarters included some wider spreads. So our interest income forecast, 9.50% versus 10.67% over the trailing 4 quarters ending September. Our realized loss forecast is pretty consistent with the last 4 quarters at 65 basis points. Unrealized losses, this is really, you can't predict. These are surprises in the market, positive or negative. I don't know anybody that can forecast unrealized losses, but our expectation is 0 versus 20 basis points in the prior 4-quarter period. So all in, 9.5 minus the 65 basis points, 8.85% forecast return versus 9.80% over the last 4 quarters. Basically, before turning it over to Fran, just want to say it's really been pretty smooth sailing in private debt, even though the business press tries to get everybody riled up. But anyway, that's from facts on the ground. Let me turn it over to Fran to dig even further into this.
Yeah, thank you, Steve. And I agree with Steve. Over the past few months, there's been a lot of headlines surrounding the private credit space. Some of the news stories written don't even really apply to the asset class, such as those around First Brands and Tricolor. That's why in today's webinar, we really want to focus on what matters, which is the data. Looking at the numbers is the best way to cut through the noise and get a clear, accurate outlook on the health of the market. Headlines may influence sentiment, and there will always be adverse events in our economy that's going to impact individual borrowers and credit, given that the direct lending index is a vast universe of over 10,000 borrowers. But it's important to be reminded that direct lenders do have the tools to navigate different market conditions, and they don't have the same selling pressure like the public markets do. In fact, some of the volatility stemming from the news cycle and from the public markets can actually create opportunities in the direct lending market. Volatility pushes more enticing lending opportunities to private markets, and it forces lenders to be more disciplined on both pricing and credit selection. Direct lending is an inherently patient asset class thanks to its buy and hold nature. So this positions it as one of the more resilient asset classes, capable of extracting value even during challenging periods. So if we flip to the next slide, before we dive into the direct lending market, I just want to start by recapping the tone in the public broadly syndicated loan market. As 2025 draws to a close, it has been an eventful year for leverage lending. The year began on a very strong note. An asset class that was starved for paper drove record repricing waves and historically tight spreads. But as the months progressed, volatility returned, and it's more likely here to stay heading into 2026. And we can start with the tariff headlines in April. You can see the impact on the average bid in the dark blue line in the chart on the left-hand side. The secondary market dropped 2 points in April, with sectors most at risk like autos, consumer retail, transportation, chemicals, manufacturing were some of the harder hit sectors. As investors digested this tariff news, we saw bids firm back up in the third quarter. Then came more headlines: rate cuts in September and October, a government shutdown, reporting delays on economic indicators, and some mild worsening unemployment figures tied to AI-driven layoffs in tech. In November, you'll notice the light gray line here reflecting the impact of investors more concerned that AI and the tech sector could pose some bubble risk. However, post-NVIDIA earnings, which were incredibly strong, we can see that tech bids shoot back up in November as the space continued to exhibit resiliency across credit. And the biggest shocks came in October with First Brands and Tricolor, both syndicated issues, not direct lending. These transactions highlight that in credit, it is often not one, but several factors that can take a credit down. With First Brands and Tricolor, the risks inherent included non-sponsored borrowers, combined with tariffs, consumers pulling back on spending, coupled with fraud. Most apparent in First Brands was the poor documentation that is inherent in the syndicated market. Despite all of this, we look at the health indicators for the syndicated market. We don't see a risk-off environment. In fact, the market still appears to be healthy because as of last week, roughly 40% of the market is bid at par or better, well above the long-term norm of 10 to 20%. That tells us that sentiment and demand in credit remains historically solid. However, investors do appear somewhat more cautious where they see pockets of weakness. And CLO and mutual fund managers are more focused on making sound credit decisions rather than just deploying capital at any cost, which is a good thing. M&A supply improved markedly in the fourth quarter, adding discipline to the market. New money lending is up 23% year over year and is at the most attractive level that we've seen in close to 3 years. On the right-hand side here, this chart shows you fund flows from open-end mutual funds. Now, these are the hot money investors who drive sentiment week to week in the leveraged loan market. Notice how flows were consistently positive during the strong economy and record M&A environment of 2021. Then they turned negative through 2022 and 2023 amid recession fears. In 2025, the biggest monthly outflow actually hit in April, nearly $10 billion when tariffs were announced. But meanwhile, in the past 3 months, amid all the headlines, we really only see modest outflows. These outflows are likely driven more, slightly less demand from investors due to the rate cuts that are coming, and we are seeing a mild rotation out of loans into high yield bonds. But there's no legitimate and real forced selling here going on in loan mutual funds. Now pivoting to the direct lending market on the next slide, we can talk a little bit more about direct lending. Unlike the BSL market, where crossover investors can move in and out regularly, direct lending investors typically make long-term allocation decisions. Fundraising has remained very strong through the third quarter of 2025. And 2025 is on track to be the third highest year on record for inflows into the asset class, supported by higher for longer rates. That said, the asset class now has a meaningful wealth presence in evergreen vehicles, which do have quarterly redemption features. These evergreen vehicles aren't nearly as liquid as an open-end retail loan mutual fund, but they do allow for some movement out of the asset class. Looking at our CDLI, our perpetual subindex, which is here on the right-hand side, we can see that redemptions have actually stayed pretty modest this year, around 1.5% to 2% through the third quarter. There was a slight uptick in June, likely tied to tariff concerns. But if you compare that to 2022 through 2023, when recession fears drove much higher redemption activity, even those years offered one of the best lending environments we have ever seen, with the highest pricing on records. Now, we'll need to wait for 10K filings to see how 4Q redemption figures shake out, but so far, stability in redemption should allow managers to capitalize on opportunities in the near to intermediate term. And if we do start to see redemptions rise in 2026, It will simply help bring even more credit discipline and higher yields to the market, similar to what we saw happen in 2023. Now, moving to the next slide, we can talk a little bit about deal flow in the direct lending market. The good news is that M&A activity and new money deals have improved meaningfully. While tariffs dampened Q2 activity in the second quarter, the third quarter rebounded with an 11% increase in deal volume, mostly from new money deals rather than the refinancing waves that we were seeing earlier in the year, which is really, really encouraging. While official Q4 data isn't out yet, our internal tracking suggests a very strong quarter for LBOs. If you look at the chart at the right, close to 40 billion in direct lending buyout deals are either in process or are scheduled to close in the fourth quarter of 2025 across the market. That momentum should carry into early 2026, barring any sort of exogenous shock. And if you dialed into a lot of the earnings calls from the BDC managers over the last couple of weeks, they also confirmed very strong pipelines heading into the end of the year. And so what you can see here in the chart on the right in this turquoise line is that nearly 60% of all LBO deals are now getting done in the direct lending market, as opposed to the syndicated market, and that is a record high. This sets the stage for attractive risk-adjusted opportunities as we head into 2026. Now let's take a closer look on the next slide at how pricing has evolved amid increased supply coming to the market and some of the shifting investor sentiment that we've seen in the last 2 to 3 months. On the left-hand side, the chart shows that direct lending first lien spreads continue to offer a very meaningful premium over public markets, about 190 basis points over single B rated syndicated loans, and more than 310 basis points over double B rated loans. So despite the adverse headlines that we discussed earlier, syndicated loans are still pricing near record lows, averaging around 300 basis points for single B credits. In contrast, direct lending spreads remain in that 450 to 550 basis point range, with large stable credits pricing toward the lower end of that range, and some tougher sectors maybe pricing a little bit higher. But finding alpha in direct lending has certainly been harder this year. But we actually do believe that there is more upward pressure on spreads in the near to intermediate term than there is downward movement in spreads. In other words, pricing should improve for lenders and for investors. We haven't seen deals dip below 450. Lenders have held the line on price in recent months. And as base rates decline into 2026, we believe spreads could move back up into that 500 basis point range and higher with more regularity. On the right, we can compare portfolio yields across upper middle market portfolios versus lower middle market portfolios. Now, historically, lower middle market lenders enjoyed 120 basis point yield premium over upper middle market managers. That gap has narrowed to only 60 basis points in 2025. Again, signaling the challenges managers have had finding alpha and enhanced yields in a competitive market. But still, all-in yields remain really attractive. If you're in an upper middle market manager's portfolio that's earning 9.5% today, that was earning only 7% in 2021. So we're still at very compelling levels from a historical perspective. Now, flipping to the next slide, I want to drill a little bit more into sentiment in the direct lending market and recent headlines. Clearly, public BDCs have been the most transparent and have felt the sharpest impact from rate cuts and volatility in news. Unlike loan mutual funds or evergreen vehicles, which have seen minimal outflows, public BDC investors, primarily retail, appear to be very sensitive to dividend cuts. The chart on the left shows that the Cliffwater BDC Index is trading at around a 10% discount to book value through the end of November. Is this sell-off a red flag or is it a buying opportunity? That's a key question that we've been getting over and over from a lot of investors over the past couple of weeks. Of course, investors' concerns are valid when you look at the chart on the right if they're very dividend sensitive. Dividend coverage ratios, right? The ability to cover your dividends with net investment income has declined for 9 consecutive quarters and now sits well below the 10-year average. Several managers have already announced dividend cuts, and the trend suggests more reductions could come in 2026, especially if base rates continue to fall. But we actually believe that a lot of these dividend cuts have already been priced into the market. So moving to the next slide, slide 13, is the drop in BDC share prices a buying opportunity? We believe the answer is yes, but it does depend on which BDCs you invest in. Dispersion in performance is certainly widening. The chart on the left shows you that the return on equity trends across the CDLI index. This includes public BDCs, private BDCs, and perpetual BDCs. A year ago, most managers easily delivered an 11% ROE. Today, that has shifted down to the 8 to 11% range. Mostly, this is being driven by rate cuts and spread compression, which have been seen market-wide. But 8 to 11% is still a very solid ROE, and it is above the long-term average for the space. And in fact, there are still 24% of managers that are still achieving 11% ROEs or better. That's really impressive. Those managers outperforming may have the following drivers: higher amounts of equity exposure in their book. They may be focused on ABL strategies or non-sponsored, which do deliver higher yield. Some are internally managed BDCs, or some have very low fee constructs. And lastly, some are venture lenders, which can find alpha compared to regular way direct lenders. Steve highlighted earlier that realized losses are only 61 basis points. They remain well below the long-term average of 100 basis points. However, there are some managers that are seeing higher losses due to credit decisions. The bottom quartile, those in the 0 to 5% ROE range, likely reflect weaker underwriting, more concentrated portfolios, or a higher exposure to tougher subsectors. Negative ROEs, while thin in the index, do signal subscale portfolios. Most of those managers have sub-billion-dollar portfolios and gross assets and may have several large single name losses within their portfolios. So manager selection clearly matters. And the chart on the right reinforces this. When we divide managers up by their non-accrual rate into quartiles, what we see is the top 25% of managers have virtually no non-accruals. And even the next 25% are still showing strong credit health, with non-accruals around 1%, which is below the long-term average. Even bottom quartile non-accrual metrics today look better than the levels that we saw during COVID. Finally, let's assess overall credit health on slide 14. The chart on the left shows default rates in private credit remain low in the turquoise line chart. The CDLI trailing four-quarter default rate was only 1.45% in Q3 25, down from 1.81% in 2024 and 1.5% in 2023. In contrast, institutional loan defaults hit 5% in September, and high-yield bond defaults reached 3%, with Fitch actually projecting further increases through year-end. But definitions do matter. CDLI defaults reflect loans placed on non-accrual, while public market defaults include missed P&I payments, bankruptcies, and distressed debt exchanges, which is a type of liability management exercise. Interestingly, these distressed debt exchanges actually account for 75% of public market defaults in 2025. If we were to strip those out, institutional loan defaults would actually be lower than CDLI at only 1.3%. High-yield bond defaults would drop to only 70 basis points. This highlights why documentation matters, why relationships with sponsors matter, and why the composition of bank groups matter. Syndicated bank groups have hundreds of investors, and sponsors can take advantage of trading prices coupled with doc loopholes. Direct lending structures avoid LMEs, and they avoid DDEs, or distressed debt exchanges. They force sponsors to work with lenders in workout situations and inject equity, which creates better alignment and hence the lower default rate shown here on the slide. Now, while defaults with the direct lending remain low, we do also monitor PIK or payment in kind usage, as it is a restructuring tool unique to private credit. So we're going to explore that. On the chart on the right, we show that the percentage of loans within the CDLI that have PIK rates turned on above the 200 basis point rate. Okay, we use 200 basis points as a guide because anything below that is unlikely to be issues tied to credit health, but rather a yield enhancer. Now, after bottoming in Q3 2024, this metric is slowly rising over the past few quarters. So today, 11.6% of loans have PIK turned on, and that's up from 10% a year ago. What's more important is where that increase is coming from. So loans marked below 90. Currently, 2.64% of CDLI outstanding loans are PIKing and are in distressed territory or marked below 90. That's up from 1.64% last year. So some of these distressed PIK loans may already be reflected in the non-accrual rate, but others might not. For investors that are trying to take a more conservative view of tracking this industry, we think that this is a really good gauge to assess risk. So looking at the mark and whether PIK is turned on. And for those of you that are really like taking that conservative view, you can assess that maybe an additional 1% of distress has happened in the industry, just looking at this chart on the right. Now, again, a lot of this rise in PIK is being driven by idiosyncratic issues and a few sectors that might be impacted by tariffs, such as consumer, retail discretionary, food and beverage. We're seeing a little bit of pressure in tech and media, and it's definitely something to monitor, but we're not seeing broad levels of macro pressure. And then finally, going to the next slide, we can just highlight the watch list. Now, managers self-report these figures, and we normalize them for you into 4 levels. Level 1 are borrowers that are outperforming the base case. Level 2, they're performing in line. Level 3 are borrowers on the watch list. And level 4 are the borrowers that have a high risk of loss. The orange line on the left shows you that nearly 50% of managers are reporting a very modest increase in their watch lists during the third quarter. However, this uptick is very, very mild. Overall, the CDLI watch list only sits at 8.6% today. That's only up slightly from 8.3% last quarter. On the right-hand side, we do break out subsets to give you a little bit more detail. The CDLI P index, which tracks perpetual BDCs, shows no rise in the watch list, likely because these managers are newer and growing rapidly. So to account for that, we did create a watch list view for managers that were launched prior to 2023, eliminating portfolios that haven't seasoned. For that cohort, the watch list is a little bit higher than the overall CDLI figures at around 11.3%, up mildly from 10.6% last quarter. So while newer managers do mute the overall index effect, the trend among seasoned managers is a little bit higher and something to monitor, but nothing materially impacting the sector. Again, the mild degradation can be tracked back to tariffs, higher for longer rates impacting borrowers from a liquidity standpoint, and mostly the large factor being idiosyncratic issues impacting individual borrower concerns. That being said, we still believe that most sectors within direct lending are performing just fine, such as financial services, technology, business services are all continuing to show strong growth, and there's no big macro pressures hitting the space. That concludes our prepared remarks. I'll turn the presentation back over to Steve to sign off.
Thanks, Fran, and thanks everybody for joining us. I hope our presentation today calms some of the nerves or reduces the anxiety that reading the business press might have created. Again, from the seat I sit in, private debt is has been smooth sailing. Who knows what lies ahead? But let me conclude by wishing you a very happy holiday season, and I look forward to speaking with you again in the new year. Thank you.